Good afternoon and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from the Quinnipiac Game Forum in the heart of New York City. Joining me for this segment is Tom McKeon. He's the Principal and CIO of Clothier Springs Capital Management. Thank you so much for joining us on set today at G.A.M.E. So let's talk about ETFs and why they continue to capture so much investor cash.
I think they're capturing so much business because they really bring global market exposures to an allocation, and they let investors large and small really make their portfolios more efficient. Instead of just a U.S. market focused allocation or a simple stocks and bond allocation, you can now have global exposures in almost anything you want. And if an exposure can bring some risk or return enhancement to your portfolio, I think you're wise to think about putting it in your portfolio.
How would you say they've changed the investment landscape?
Well, I think that since so many of them are based off passive indexes, it's really made investors focus on the evidence that leads you to want an exposure in your portfolio. Compared to active management, these are all very tightly, tightly tracking to an index, and you can look at the data, you can gather your own opinion about how it's going to interact with your portfolio, and then put it in your portfolio for basis points. And I think it's really a game changer in our world.
How do you think ETFs have changed the advisory business?
Following that same line of thought, it's let advisors expand their portfolios, expand their efficient frontiers, and bring better returns or less risk to their clients. And I think that's a winning proposition.
All right, now let's talk about options. How do they help to enhance portfolio risk and reward profiles?
So I use options in a very simple way. I sell covered calls on about half my equity exposure for my clients. And as you know, or maybe your viewers know, you collect a premium, and that premium gets to be part of your total return, and it changes the risk and return profile of the long-only strategy to be a little less volatile. It's got less upside capture, but more return over the rest of the range of the possible outcomes.
Particularly in the low interest rate environment, too, it's a good way to also generate some income, which investors are always looking for. But let's talk about that. What is the distinction between investing and trading?
So I started out in life as an option trader on the floor of the Philex, and I moved to the investing world as an investment advisor, and I recognized early on that you have to wear two hats. Trading as an economic activity is just trying to take small gains out of short-term trades. And for what I do, trading is just putting my ideas into a portfolio. So what I'm trying to do is capture exposures that earn returns for a portfolio, whereas a trader is trying to capture short-term movements as an economic gain.
All right, and to wrap up, let's talk about the investing revolution, and how does that help to support the evidence-based investing program?
Well, ETFs are built on indexing, and it's really let investors and advisors look at the data and say, you know what, this makes more sense for me, for my clients. These low-cost passive exposures is a better way to help clients earn returns. And the index revolution is well underway, and I'm a believer.
Well, thank you very much for joining us today at G.A.M.E. And traders, thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.